Uh, Hi everyone. Thank you very much for joining us today. I think it's our first webinar of the year. Might be our second. You lose track sometimes. The year seems to be passing by so quickly. But we felt it was an important point in time really to get ready for the new tax year. So I'm going to take you through a presentation. Anyone who came to the budget update back in November, I think it was, some of the information presented will be similar. But ultimately, no one will have forgotten the impact it's going to have on business, but we obviously going to go through it in some more detail. So, um, so I'll leave you with the words of the great Bob Dylan. The times they are a changing, and really they are a changing. So, when we looked at the impact of the budget, it was a bit of a slow burner of a budget, lots of moving parts. Took a while to unpick, identify what was going to impact businesses. But now the times are actually going to change. We're a couple of weeks away from the new tax year, and with the new tax year, a raft of changes that are going to affect you as businesses, us as payroll professionals. So it was important that we at least set the scene and talk about the things that need to be talked about. So with that, I will leave you to view the agenda. Number of topics, some of which will be familiar. You would have struggled with daily since that budget speech in late last year. National minimum wage, we've become accustomed to an annual visit to national minimum wage, national living wage. National insurance, the biggest changes that were going to impact us as businesses were in the national insurance arena. Employment allowance, some mitigation of those effects. Neonatal care leave and pay. I didn't cover those in the post-budget one, but they are equally important. Small employers relief. That was one that wasn't, I don't think, even announced in the budget. If it was buried deep. Salary sacrifice with increases to business cost. There is an element of salary sacrifice. Should I look at it for certain parts of my business expenditure? P11Ds, in terms of the start of the tax year, we'll be very quickly looking at P11Ds. They come thick and fast. The deadline is 6th of July, but obviously we need to prep beforehand. Mandatory payroll in a benefits in kind, the biggest change in payroll in recent past, which is something we need to visit again and again and again. So I think I've given late attenders an opportunity to settle themselves in their chairs. So we will now go to the structure of the presentation. So national minimum wage, clearly the biggest impact on businesses was likely to be the change to the national minimum wage. We'll all be familiar with it now. The annual changes, always an increase that is greater than inflation, clearly putting a cost on businesses. This year, national living wages rising by 6.7%. 18 to 20-year-olds in rates are increasing by a greater percentage to £10. And that is basically starting the government's remit task of removing the age-related band. So ultimately, they're trying to get everyone off of those age-related bands in order that everyone of any age is enjoying the national minimum wage. So ultimately, we're all quite familiar with that. It used to be in October, now it's in April. Tax and national insurance changes. National insurance rate is increasing by 1.2% to 15%. So from 13.8% currently to 15%. So 15%, that's quite a lot of money, isn't it? It's quite a high percentage. The national insurance threshold is changing. A bit of a stealthy one, that. The fact that the rate's changing, the threshold is changing, means that life is not simple. Assessing the cost is more difficult. The employment allowance has changed. So it's changed in both in monetary value and removal of the threshold. So there's a twin attack there, which is going to have an impact on most businesses. And then income tax, For as many years now as I can remember, if I got a short-term memory, the emergency tax code 1257L is something that we can all remember and has been in place for a good number of years now. And then, it's not going to be extended beyond 28, 29. Who knows what will actually happen? But income tax, obviously, it doesn't affect your costs as a business. It does affect what gets to your employees in terms of net pay. So it's a consideration, something that it's that sneaky way of making sure that people pay more tax as their wages rise, but the thresholds don't. Impact on your business. So the impact does vary business by business. So we've done a good number of budget forecasts for the coming year, looking at the impact of those various changes, all those moving parts. What do they lead to at the end of the day for your business? For an employee aged 22, over 22, and they're currently paid the national minimum wage, the absolute basic increase in your cost for that employee will be 2.5 grand. So a fairly significant sum, something that businesses have been planning now for quite some time. Nobody likes it, but everyone's got to do it. So, that's the headline number really. 2.5 grand per year to employ the same person who sat there in March. If they sit there in April, they're suddenly costing you uh, 2.5 grand extra, £200 a month, not insignificant. You can take another example, which is someone aged 22 plus on a salary of £30,000. There, the impact of each element is different. The NI rate and threshold changes will lead to an increased cost of £864, but there is no obligation for you to increase their pay. Because they're above the national minimum wage, there's no problem in those terms. What, of course, you do have to consider is what effect is the national minimum wage rising for your lower paid staff? What impact does that have on your higher paid staff? How willing are they to continue to carry out those additional duties if the difference between them and the lower paid workers is shrinking all the time? So many businesses are increasing across the board or selectively. And so in truth, when we've carried out budget forecasts, the real impact will lie, it won't be either of those numbers potentially. It might be for an individual, but within the business, the cost of your employee costs, your employment costs will have risen by an amount per head, and it will vary by business, which is why we've carried out budget forecasts, looking at where you are now, where you will be come the new year, and what impact it has, so you can plan and make sure those changes don't catch you unawares. Obviously, with increased costs for an individual's wages, there are additional employer costs, notably holiday pay and pension costs. If your salary goes up, your pension cost is going to go up. The cost of holiday pay, depending how it works, is going to rise too. There is some mitigation. The employment allowance is increasing as well. So it's increasing by £5,500, currently sits at £5,000, which it's been for a number of years, but it will now rise to £10,500. So the Lord giveth, the Lord taketh away, or in this case, it's the reverse of that. So the exchequer is giving you something in return for taking something. A bit like a salary sacrifice, really. So the employment allowance. The employment allowance is increasing from £5,000 to £10,500, as I said. What I didn't say, I don't think, was that the £100,000 threshold is being removed. So previously, if your national insurance employer's national insurance cost was higher than £100,000, then you couldn't claim the employment allowance, and that excluded a large proportion of businesses that we deal with day in, day out. That's changed. That threshold has been removed And so many businesses who for 3 or 4 years haven't been claiming because they knew they had no opportunity to, they were instantly ineligible on the basis of their NI costs. They now potentially have an opportunity to claim. So it's a change of mindset, thinking about when I get that email from Cox & Co, do I need to respond to it? How do I need to respond to it? So according to the government, because I do litter it with government propaganda from time to time, this increase means that over 865,000 employers will have no national insurance liability next year, and more than half of employers with NIC liabilities will either see no change or will gain overall next year. I have to say that that is not our experience, and I will leave it there. There are very few businesses that we've looked at who are going to be better off post change. I think that must refer specifically to NIC's no reference to national minimum wage, and it must be very selective and one of those things that you can justify, but wouldn't BBC Verify probably wouldn't be able to come up with a verification for that one. But anyway. Other eligibility criteria remain unchanged, though. So the threshold bit has changed, but the other elements haven't. So on the next slide, we consider those other eligibility criteria. I think it's fair to say, with the change in threshold, most businesses and charities, certainly that we deal with, will be able to claim. And that's at odds with the last few years where most businesses and charities definitely wouldn't have been able to claim. So being in a position where you might be able to claim, you then have to go through the flow chart a bit further and consider, is there any other aspect or criteria that I can't meet that would prevent me from making a claim? So the things you need to consider, and when we ask you to declare your eligibility or otherwise, we will signpost these. But the most common ones that we find that lead to companies not being eligible, or one of the group of companies not being eligible. So the questions you probably need to ask in the majority of cases are you part of a group of charities or companies? So if you're linked, if you're connected to another business entity, you need to consider what that relationship is. Will it impact on my ability to claim the allowance? So it's a very important one. We've certainly come across a fair number of businesses that were connected to other businesses where that connection was not clear, very difficult to establish. Someone within the business didn't realize it existed. So we've often sat and said, are you absolutely sure you're not connected to that business? Because we think you probably are. Ultimately, it will be your declaration, not ours. We can lead a horse to water. We can't make them drink. There will be circumstances which make life a bit difficult in this respect. But you need to consider it. It's £10,500 for you. If you consider it, give it the respect it deserves. Think about it before you say yes or no. Do you have more than one PAYE scheme? So again, you can only claim the employment allowance against one of those PAYE schemes. So we deal with a lot of charity clients, and they very often have a trust arm and a trading arm. So they have a part of the charity that is trading, making a profit, and it's then one way or another, in ways I don't understand, moved to the other charitable part of the organization. So in those cases, then you can only claim for one of those. And again, it does cause some confusion. Which one you claim it against may be something you need to consider before you do it. So it's definitely one to think about. Director only payrolls. So there are, if there are only one or two directors within the business, if there's one director, then you cannot claim. It is a very simple answer. If, however, there are two or more directors, then assuming those directors are earning in excess of the secondary class one national insurance threshold, or the employer's national insurance threshold, as it's otherwise known, then you can claim it. And again, there are sometimes opportunities, where employing someone, allows you to claim something you couldn't otherwise claim. Obviously, you have to pay national insurance first, so you can only claim against employers' national insurance. So, yeah, there's always a trade-off, a consideration to be made there. So the other criteria we come across which excludes people from claiming the employment allowance is how much of their work occurs in the public sector. So we've got businesses where more than 50% of their work is conducted in the healthcare sector for the NHS quite directly, and they can't claim because of that. And again, if you were near the cusp, your accountant would probably be the only one who could tell you, because what the guidelines don't tell you is more than half of your work. How do you measure that work? What over what period of time? You know, if you're accruing for income that hasn't come in, it's a very difficult one to quantify. I'm sure if it's 70-30, it's very easy, but if it's 49-51, it's a bit more difficult. There's always a cusp and there's always someone on it. So yeah, most of you probably don't engage that much in the public sector, but some of you will. So local authorities, healthcare, NHS, those type of things. So again, that's something that we certainly see people declare themselves as ineligible because of those associations and where their work comes from. How do you claim? Okay, so or how do we claim? That's a royal we. How do we claim? So it's claimed through payroll. You declare at the beginning of a year whether or not you're eligible, and that then carries on with one or two exceptions through the year. So we imminently, I've put, because it may have gone out or it may be about to go out, but we will send you a declaration, a link to a form that you will need to complete. And that will lead you through a series of questions which should hopefully guide you and bring you to the right conclusion. We would ask that you complete it and submit it without delay. So we're getting it out earlier this year. Previously, we had to wait and establish what your employer's national insurance cost was for the year just gone in order to claim it for the year to be. So if your payroll was run on the last working day of the month, we couldn't physically get it out until the middle of April or whatever it might have been. Close the tax year, make sure it's all tied up. Then we know what your what your national insurance cost is. We don't have to wait anymore because that 100K is not a relevant factor anymore. So we're doing it earlier. The earlier it's sent out, the earlier it's sent back to us, the earlier we can claim it, and the less confusion there is likely to be on your PAYE remittance documents that we send you. Every month we send you details of what you owe to HMRC. If we do that early in April, we have a pay date, maybe the 15th of the month, and you haven't declared your eligibility, then we will assume, quite rightly, that you're not eligible. We can't make a claim without knowing you are. That means that once you make a claim, that liability for April may change. It all gets a bit confusing all round. HMRC will allocate it one place, we'll tell you somewhere else, and it's just not straightforward. So my plea to you is please take note of that email, respond to it as quickly as you possibly can. As I say there, you may need to seek advice from your lawyer or tax advisor because circumstances may be more difficult, tangled than the norm. But for most of you, it won't be a complicated affair. It will be relatively simple. From our point of view, we require for audit purposes, auditability of payroll. We want a response whether you're eligible or whether you're not. On many occasions, we're asked by auditors, the client is asked, have you claimed the employment allowance? They'll then come to us and say, have we, Steve? Have we claimed the employment allowance? We'll say, well, you know, you considered it? Did you complete the questionnaire, the eligibility declaration that we sent you? Because if you did, you'd have a very clear understanding of what the employment allowance is, how it works, and whether you were eligible. So if nothing else, you save yourself, you know, 30 minutes of an auditor's time by being able to answer the question instantly. If we've all got a document that says yes or no, we're all in a position to make that, quick assessment, deal with the problem head on. So that's sooner the better, from our point of view. We will constantly chase for ones that are missing, but ultimately, very often we were in a position where we'd send you something that said your national insurance cost is over £100,000. Can you tell us if you're eligible or not? And it's like we seem a bit stupid. We're asking that question. We know the answer because it's there in black and white. The problem is that auditors have a tick list. Tick list says, are you claiming? Are you not claiming? It's important that everyone in the process understands, and it is participating in that. Finally, I add it again there because just remember the £100,000 threshold has been removed. You need to consider it. So, it's something you could have ignored. Many of you could have ignored it up until this coming tax year. Now you can, or you can, but it costs you 10.5 grand and you get a load of emails from us saying you haven't declared your eligibility yet. Could you please do that? So the next thing I've got on my list is neonatal care leave and pay. So obviously this is coming into effect for the coming tax year. And I'm still getting to grips with it. Although people within our business are very much to grips with it because they've done videos and write-ups on the website about it. But I still have to refer to the wording to make sure I get everything absolutely right. So eligible employees will be entitled to up to 12 weeks of neonatal care, NCL, neonatal care leave, NCL, to care for a baby hospitalized within the first 28 days of birth. Leave is in addition to existing maternity, paternity, or shared parental leave entitlements. So that's what the Act says. In terms of neonatal care leave, it's a day one entitlement. So all employees qualify regardless of length of service. So someone walks through your door on Monday, they qualify for it on Monday. A bit like some other things. Sick pay, for example, that would be the same. The minute you walk in the door, if you've got a contract of employment, then SSP would apply. Leave applies if the baby is hospitalized for at least 7 consecutive full days. So there's a criteria that needs to be met there. And leave must be taken within 68 weeks of the baby's birth. For neonatal care pay, the criteria are exactly the same, I think, if not absolutely super similar to SMP and shared parental leave. So you're looking at the same things. Have they been continuously employed for at least 26 weeks? And do they earn an average of at least £123 per week? So I've said similar to the criteria for maternity pay because I'm sure somewhere deep within it there is something that would mean that if I said it's exactly the same, I would be wrong. So in essence, leave is an instant, and pay for it is obviously subject to certain strings. Small employers relief. So some of you will be aware of small employers relief and some of you won't, because it only applies to, as its name would suggest, small employers. The definition of a small employer, of course, is there as well. So at the moment, if you have someone on statutory maternity leave and you are a small employer, as defined there in red, so less than £45,000 in Class 1 national insurance in the last full tax year, qualify to claim 100% plus an additional compensation. That additional compensation is currently 3%. And for the new tax year, it rises to 8.5%. So it's interesting. It's going backwards. I remember the days when it was It was higher than 3%, significantly higher than 3%, but I am quite old, to be fair. But it's going back in the direction, although with the criteria now that, hasn't moved forward. It's a bit like tax thresholds. That £45,000 hasn't moved. Obviously, your workforce is costing you more, so less and less employers will be classed as a small employer. But ultimately, it's something the government has given, so we shouldn't, say anything other than positive things about it. And it applies to all statutory parental payments, basically: maternity, paternity, adoption, shared parental leave, parental bereavement pay, and the newly established neonatal care pay. So small employers relief. That was a bit of a, like I say, it was a bit of a surprise. I don't think anyone really cottoned onto it. If it was, I'm not absolutely sure it was in the original budget, but I think, yeah, people grew to know about it in perhaps January, something like that. We certainly did. We do study what might affect us, but that one escaped. Salary sacrifice. I bring this in only really because salary sacrifice is a growing area for employers because it offers an opportunity to mitigate some of those additional costs. So salary sacrifice is a route you can use for various things. It used to be a route you could use for pretty much everything. If you wanted to buy a stapler, you could do it through a salary sacrifice. If you wanted to buy a wheelbarrow, you could do it through salary sacrifice. You could do pretty much anything, but obviously the government realized that that was probably not what the intention was. And so salary sacrifice now is is rendered useless by things like the optional remuneration arrangements. So basically, it's fairly restricted in where it can be useful, but it can certainly be useful in the area of pensions. So we've seen an awful lot of growth in employers moving from a relief at source pension provision to a salary sacrifice pension provision, and an increase from 13.8% to 15% employers' national insurance makes it more attractive for the employer to do that because the employer is going to make a saving. So there you can see the pros and cons of salary sacrifice. Salary sacrifice for pensions is worthy of consideration in any business. But there are pros and cons like everything in life. It's not all good. Sometimes there's some bad, some things you need to consider. But yeah, we've done an awful lot of work on pension salary sacrifice in recent past. People look at it, it's a way of making their money go further. We recently helped the introduction in a business where, for them as a business, it realized an annual saving of about 40 grand. Not insignificant. Some people are already benefiting from that, so they won't be able to do it again, unfortunately. But it gives immediate tax relief at employees' highest rate of tax. So that can be a plus for higher earners who, when I talk about claiming tax relief through their self-assessment tax return or via contact or by contacting HMRC, some give you the look of someone who may not have actually done that, in which case you lose in tax relief at the higher rate. A salary sacrifice gives you that immediately. You don't need to worry about a tax return. NI savings reduce the employee pension cost. So the employee derives a benefit. Some of the work the government has done in terms of trying to put more pay in people's pockets, namely reducing national insurance, employees' national insurance, has made the benefit from that smaller. You were saving 12% 18 months ago. Now you're saving 8%. So the savings aren't so great. Conversely, of course, the employer national insurance rate, which is rising, the saving becomes more attractive. So it's worthy of consideration. The things that you should look out for on the con side, so to speak. Non-taxpayers do not get tax relief. So if you have people who are not paying tax for one reason or another, probably most commonly if they're working, part-time, maybe 2 days a week, they've not hit that 12.5 earnings threshold, they won't get tax relief through salary sacrifice, whereas through relief at source, even they will get tax relief. Everyone gets tax relief at 20%, even if they don't pay tax. National minimum wage and national living wage compliance, because those are rising at quite a rate. When you enter a pension salary sacrifice, it's a change to your contract, and by definition, it reduces your pay for national minimum wage purposes. So it effectively reduces your hourly rate. Obviously, as those hourly rate, more and more people, anecdotally at our end, appear to be on that, at the 11.44, 12.21 kind of rate. They can enter a salary sacrifice because they cannot go below the national minimum wage. So you perhaps couldn't apply it to all your workforce, but you can always apply it to those who would benefit. So it's an option, perhaps worthy of exploring at least. And it can affect entitlement to statutory payments too. Usually they'll be offset by the benefit, but they should be considered. Again, if you have a benefit that's based on your pay, in a salary sacrifice, your pay drops. Therefore, it could affect your benefit, statutory payment. And the one I haven't got there, I don't know why I've missed it off this time, is people who are looking to borrow some money for a mortgage or for other reasons. I think generally speaking now, salary sacrifice is such a common vehicle. It's so, it's out there. Lots of people are using it. And extra steps are taken to make it transparent on people's pay slips. But there may potentially be lenders out there who aren't, who would still not look at the whole picture. They just look at your taxable pay and it will be lower, and perhaps that might affect your ability to borrow. So it's not without risk, but it's worthy of consideration, and the benefits can be quite reasonable. And then excuse me, losing my words, salary sacrifice holiday arrangements. Again, they came into vogue. They seem to be diminishing again a bit now, but the opportunity to buy or sell holiday sometimes through a salary sacrifice arrangement. It's certainly, it came to, became more common, I think, because it's beneficial to employees seeking flexibility or a better work-life balance. An employer can use it as part of a more attractive benefits package. So it's there. I mentioned in salary sacrifice, I mean, really, you don't see much else. Childcare vouchers are pretty much dead now. Obviously, once they were stopped, you've got some people who sit on them historically, but no one can do childcare vouchers now. So ultimately, they've died to death. And obviously, you get electric car salary sacrifice as well. But those are the kind of two main ones we come across day in, day out. But yeah, if you're looking at employer costs and ways of reducing them, then salary sacrifice might be a place you would look. Yeah, so P11D, P11DB, the season is fast approaching when we need to consider them. Not long after the email, it will tell you about employment allowance, how to claim it, etc., etc. Leaves our computers. The next one on the agenda will be P11D time. Do you have any taxable benefits or expenses that need to be reported? What are they? And, provide us with details of what type of expense it is, sort of other information we would need to decide how it was going to be taxed, stroke national insurance paid on it, who procured the service, who paid for the service, all those type of things. So it gives us a chance to ask the questions that become relevant in terms of reporting. So I mention it now because I may not virtually see you for quite some time, by which time it would be too late. So, and we are coming across more businesses who provide benefits, but kind of forgot. And, I think it's important that, benefits, if you provide something to an employee, if it looks like a benefit, smells like a benefit, it's a bloody benefit. So be very careful, understand fully what it is. And we'll all be okay. P11Ds, I mean, I've lifted this slide from my P11D webinar as well, I think. So I just thought, I'll stick it in there because I need to remind people P11D season is coming. There are still unanswered questions about payrolling the benefits, and until we have an answer, us payrollers are quite we need an answer. We don't like grey, we need black, and we need white. And until someone can give us black or white, we'll stick with something that is. But yeah, next slide we'll talk briefly about payrolling the benefits because it's our number one favorite subject, I think. But currently P11Ds, they're done post-tax year. By the 6th of July, we obviously ask who has those benefits. We then send you a letter of engagement outlining our costs and a timeline for preparation and submission. So that's something that we currently do. People like John, there are plenty of people like John out there who are preparing P11Ds themselves, either because they're relatively straightforward. Their accountants might prepare them potentially. There are all types of reasons why we might not be involved in it. They've always sat between tax specialists, accountants, and payrollers. And we've always done them. If we've been asked to do them, we've never gone out and said, "Oh, who's doing your P11Ds?" We'd love to do them because frankly, they're quite complicated, more complicated than most people think. But yeah, the time is fast approaching. And then we calculate it and we Class 1A national insurance needs to be paid by the 22nd of July. So that's one on the horizon. You'll be hearing from us in due course. So next slide. Why payrolling? I think I've missed that. Like I say, I lifted these slides from my payrolling of benefits presentation, which was like umpteen slides. And I thought I'd just give myself enough to get the point across, really. But as John quite rightly says, mandation of payrolling of benefits will be effective from the 6th of April 2026. And what that means is if you do P11Ds for this tax year that's about to end, you can do them for the next tax year that will end on the 5th of April 2026. After that, you won't be able to do them except for a couple of benefits which may not be adequately dealt with through payrolling. Interest on business loans being one of them, and I think accommodation is the other one. Now, how you ever get to calculate in real time interest on a loan is anybody's guess, and I think HMRC recognise it's anybody's guess. You are allowed to do it if you can come up with a formula that works. You can do it, but I think common consensus is that at the moment, no thanks, we won't. But from April 2026, it becomes mandatory, and whoever runs your payroll will need to process and report those benefits in a real time. So each payroll, we will include benefits in kind on employee pay slips and will calculate tax and national insurance on those benefits. I won't go into whether it's a good thing, a bad thing, or something in between, because I don't think it's the place to do it. We don't have a choice in it. That's the reality, and so we'll have to do it. So we have talked, are talking, and will talk about benefits in kind. We're upskilling our team because they are quite niche at the moment. Once a year you worry about them, the rest of the year you don't. So you can afford to devote a resource at a point in time to deal with that issue. If you have to deal with benefits on a day-by-day, week-by-week, month-by-month basis, the challenges are different, and you need to have a greater depth of resource to deal with that. Obviously, HMRC are implementing as part of a wider plan to digitalise the tax system. Okay, that's great. It means they can take people off the phones if there was anyone on them. Removes the requirement for annual filing of P11Ds and P11DBs, replaces them with a requirement to provide employees with an annual statement of benefits. So not much changes there, but if you change the wording, it sounds like you save some time. Income tax and Class 1A national insurance will be reported and collected in real time. Not quite true. Income tax will be collected in real time. Class 1A national insurance currently will still be collected at the end of a tax year, 19th of July. So that bit hasn't changed. I think there's no doubt it will change. Why would you measure these things on a month by month, week by week basis and not seize the opportunity to get some extra money in your coffers. But at the moment, that is definitely not happening. Practical considerations. I'll talk about the practical considerations of payrolling of benefits. It is here. As I say, the titles on these slides are a bit misleading. What about the timing? We all have our part to play. So I think all I'm really saying there is there are a number of parties involved in this activity, all of whom have to do something, think about it, communicate things, educate their workforce, all these type of stuff. So HMRC is currently consulting with stakeholders. That was true probably a year ago and is still true now. They're still consulting with stakeholders. They still have decisions they need to make. Excluded benefits. So as I say, 2 are excluded from mandation, but can be reported now. Tax code adjustments. HMRC have to deal with the tax code adjustments. I would have covered that more in more detail in one of my payroll and benefits webinars, and we will definitely do those again. As it becomes more pressing, then we will definitely go there again and again and again. Employers need to define parameters, they need to gather data and decide how they're going to record these things. Again, for the employer, it's a big change. Currently dealing with it once a year, you can then forget it. You have to deal with it on a day-by-day basis. If a car changes, you need to know about it now. It's not satisfactory to know about it 3 months later. And some don't record those changes until you get to the end of a tax year. I know through experience, because we deal with them. So you need to change your systems to accommodate the new requirements in terms of information. Education and communication, lots of changes for employees to get their head around. Short-term changes in their net pay, where they're paying 2 lots of tax in the first year of payrolling. Understanding the principle involved. Why has my tax code changed? It doesn't include my company car anymore. Should it? No, but explanations need to be had. People need to understand it. Define the benefit and tax treatment. This is for us now. We need to set up our software. We need to include it on relevant reports if we do those. We need to decide and make sure it's stated on pay slips correctly. The description matches what we're doing. And additional charges. Clearly, it doesn't come for free. We have stuff to do. There are more demands on us. We need a greater skill within our workforce. We need our software to do better stuff. HMRC obviously don't bring that into their thinking. They just say, yeah, less admin for you employers. We save you some time, therefore we save you some money. I'm not sure employers will save time because, as I say, they need to consider it day in, day out. But these are all things that we have to, as a group, consider. And that's why we very much are trying to educate people. We're talking about it every opportunity, and we will certainly run webinars and sessions to make it clearer.